Hi everyone. Today we're following up on the previous video where I have magically lost 15 USDT, and the only clues about what happened could be found in the core logs. Essentially, there seemed to be a communication problem between the core and Binance. The core lost control of order placement and movement for a while, and 5 open positions were orphaned. And once, for some reason, the communication was re-established, the unrealized P&L of the open positions triggered a panic close. Here I have actually added these so-called trades into my report manually, just so that I have a more complete picture of the P&L. I had to assume what algorithm this may have been. I know the side, and on the buy side the only algorithm that had all of these coins was the 1.1 distance. For the losses themselves, I split the 15.04 USDT between the 5 trades according to their leverage, approximating the liquidation levels inherent to each of them. This gave me an ROE terminal value and the price delta value based off the order size of 100 USDT as per the algorithm. Then, based on other similar trades, I have assumed the amount of fees and reverse calculated the ROE margin based on the known leverage values. The close date and time are known, but the open time is unknown, and potentially it is 3 hours prior to that. But I inserted the same time as the close time. The 3 hours would have screwed up my addition here, the average open time, and it would have been screwed in a major way. Maybe this is overkill, but I like the data to be as complete as possible, and I would like to be reminded of what happened. Also, I put a trade ID as 0 here so that I could easily filter these trades out when necessary. When investigating the whole thing, I came across the fact that around that time, the other trades did show up in the report, and they had remained open for an inordinate amount of time. The average time was like 3.5 minutes, the max was 5:23, and the minimum, yes, the minimum, was 1:19. This basically turns the seemingly controlled trading environment into more of a lottery. Even for emulators active at that moment in time, the average open position duration was like 1.5 minutes. I do not have saved images of that anymore on the graph, but I do remember it looking something like this. This is a screenshot of a weird-looking trade that I took a while ago. Here, as I imagine, the limit order was executed, the position was opened, but the corresponding take profit and stop loss failed to materialize. And as you can see here, after about 30 seconds, the take profit and stop loss did show up, but again failed to execute. See right here on the graph closes the stop loss line multiple times before finally filling the stop loss order in another 10 seconds. Why am I paying so much attention to the duration of open positions? Well, may I remind you that these are shots, and the intended mechanism is to wait for a rapid price change that rolls back almost immediately to secure your take profit. Obviously, what I'm seeing here is far from the original intent of the algorithm. Of course, there could be valid cases where the price does not roll back enough and keeps hovering between the take profit and the stop loss line, but that shouldn't be the majority of cases here. So I decided to take a deeper look into my open position durations, and to see whether or not this affects the profitability of the trades. The easiest first step is to look at the average duration for profits and for losses. Let's do real trades only. So the overall average duration for all real trades since I started doing this is 17 seconds. For profits it is 15, and for losses it is a whopping 26 seconds. Even though this test is simple, it becomes obvious that the longer a position is open, the more likely it is to end up in a loss. Alright, let's dig deeper and break down the total USDT and the ROE numbers for each recorded number of seconds. Of course, this calls for a pivot table. We'll look at the real trades only here. Here I've got each line representing a duration, And in the columns, I've got the total USDT and the number of trades. Then I've also got the average order size for each duration to help me calculate the ROE according to my revised formula, and then the ROE itself. As you can see, the majority of trades happen rather quickly, within, let's say, 5 seconds from opening, but then there's a whole lot of trades that seem to go on forever, topping out at 9 minutes and 33 seconds. Let's go back up. Obvious at the first glance is the fact that the very short trades are very profitable. Of course, this is aided by the fact that I have a stop-loss delay in most of my algorithms, anywhere from 1 to 2 seconds. Therefore, the first two numbers may be a bit inflated, but the general premise still holds. I've actually checked the reports for the period before I introduced a stop-loss delay across the board, and the same remains true. 0 and 1 second durations are profitable, and the trouble starts after that. Back to the whole picture, I've also done an approximation of the cumulative ROE that works like this. It is not fully mathematically correct, as explained here, but it is useful enough for what I'm about to show you. Here I have a graph of how the cumulative ROE changes depending on the open position duration. Peaking at 1 second, it starts going down, and it is all downhill from there. In my particular selection of trades, after 58 seconds, there is no way back up into the profitable zone. And this is confirmed here as well in the table, of course. But let's take a step back. Let's take a huge step back. What kind of craziness is this? Having shots trades closing for so long. 2 minutes? 3 minutes? What is this? This is again not normal, and I want to get to the bottom of this. Where did it all start? And could it have something to do with the fact that my trading started off quite strong, but then it took a turn for the worse? As you have seen, I started to build my reports not from the very start, but about a month in. So I went back for the reports from back in the day when the algos were simpler and the profits were greener. Here are the reports for the first month of trading. They look a bit simplified because I did not fully have the algorithm naming convention down to populate the whole thing, but it is good enough for our purposes. Now check this out. Watch the average counter here. Okay, we are at 0, then it goes up a bit, to 1, to 2, then it all of a sudden jumps to 7, and then over 10, and if we go all the way down, we end up with an average of 49 seconds. Even if we were to exclude some absolutely crazy outliers here of over 1 hour, we'll still be at 31 seconds on average. What is going on? Let's look at the algos that are responsible for this. As you can see, it seems to start with the test algorithm. This was when I started doing active markets on a big scale. Before that, from what I remember, I had more regular algorithms that were not so taxing on the core. So, it seems that even though the core was not crashing, and it seemed to be holding up, the speed at which it did its job was getting progressively worse. And once I got into the heavy battery of algorithms for my distance grid experiment, it likely got much worse. Remember this picture from the beginning of the video? It was taken somewhere around that time, and at high BTC volatility no less. The latency and the loaded core just barely survived without crashing, but the quality of trading was down in the dumps. You want more proof? I do have it. Check out this series of trades. They were a part of another massive experiment that I was running in parallel to real trading. What caught my attention is that there is a series of dozens upon dozens of straight-up losses, which is absolutely unseen on an emulator, at least in my experience. So I looked at them individually, and they all look like this. What is this? No shots, no indication of where the position was opened, only stop losses all the way, and it's all flat. The report says that this was on the P algorithm, which is supposed to be active for a flat Bitcoin. However, let's look at what actually happened with Bitcoin at that time. Based on the graph here, we can estimate that the 5-minute delta was around 2.3% at the time, which means that none of these algorithms should have been active. This is garbage data. Garbage in, garbage out. None of this data can be trusted now, and I will have to scrap the whole thing, throw it into a dumpster, and start over. Alright, I can easily do that with emulated trades, no harm done to my wallet, but what about the real trades? They suffer just as much in this environment, and I cannot just forget about the 15 USDT that I just lost without any control over it whatsoever. I have to put an air gap between the mad scientist style experiments and the real money. I am getting a second server. One will be for real trades only, and the other will be for experiments. And on both of them, I will be watching the average open position durations. And I have to figure out what affects them and how I can bring them down to a reasonable level. As seen from this graph, the best is 0 seconds and 1 second. But okay, let's for starters extend this a little bit to accommodate any delayed stop losses that I may have. Let's say 4 seconds. That's what we'll be aiming for. So I'll go digging for ways to stop this madness. I have been so focused on gathering massive amounts of data and analyzing it that I forgot to check whether this data is valid and clean. Big mistake that cost me over 30 USDT in P&L, but on the other hand, I learned a lesson. As for the balance, it is still there at 188. I shut down all the real trading until I could figure out what in the world was going on, and until I could get this whole thing under control. So, what have we learned today? Number 1, the duration of open positions matters. The longer it stays open, the more likely it is to be a loss, and this will become another indicator I'll keep track of. And I'll be looking for ways to bring it down to an average of 4 seconds at most, for starters. Number 2, do not load the core to its very limit. Yes, it can take it without crashing, but at what cost? The cost is losing reaction time, losing control, and thereby turning your trading into more of a lottery. Number 3, keep real trades and emulated trades separate. Real trades should get all the priority and all the resources they need, especially during high volatility. Ideally, when I get to a decent trading volume, I'd probably get off of emulation completely, but for now, I'm going to put an air gap between the two by using completely different servers. Number 4, keep the big picture in mind and investigate exceptions. Whether it be through reports, graphs, logs, common sense, or otherwise, find out what went wrong when something is out of the ordinary. This was the starting point of the most recent 2 videos, and I hope that the lessons learned, once properly digested and implemented, would lead to more successful trading in the future. Overall, these are all lessons about control. If you remember, the premise of why I went into automated trading in the first place was to get more control and predictability. Now it becomes about staying in control and keeping the randomness introduced by various other factors at bay. That said, I hope you learned something for yourself as well, and I will see you in the next video.